Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover Velocity Banking 102. And we're going to learn about paying off your mortgage much quicker than your average American would. Um, so first thing I want to mention is that if you haven't watched Velocity Banking 101, go ahead and watch that first. You'll get a much better foundation about what Velocity Banking is about, and then come back here to learn about the next step, which is about paying off your mortgage. Another thing I want to mention is that if you want to interested in joining our group, go ahead and go to the About section in our YouTube channel and go ahead and email us so you can find our email address there. Another way you can reach out to us is by clicking the Google form link in the description below and go ahead and copy and paste that into another tab. Just to let you know, Google doesn't let you have clickable external links unless you've been with YouTube or posting on YouTube for like 2 months. And since this is a YouTube channel, it won't allow you to have a clickable link. So you got to copy and paste. Now, back to the topic. Uh, Paying off your mortgage quickly, velocity banking. Why is this needed? So as you can see here from this news article, we see that the majority of recent home buyers say they struggle with payments. So about 62% of new home buyers have struggled when it comes to paying off their mortgages. And if you had a mortgage or recently bought a home with a mortgage with this year or the past year, you're probably a very high income person, especially given that property prices haven't gone down and the mortgage rates have gone even higher. So this is almost kind of like a high income problem nowadays because those are the only people who could actually get homes. But out of those people, 62% say they're struggling. And another thing that I want to mention, and this we talked about this in another video, is that there was a study that said more than 80% of millennial first-time home buyers regret buying their home. So I think that if they learn this strategy, then they won't have that regret. And I'll talk about in more detail how the strategy works in my personal case study and testimonial. Now, let's just do a quick bird's eye review of Velocity Banking 101. So what is Velocity Banking about? Basically, if you watch that video that I talked about, that's going to be in the description. Go ahead and click it. But you learn to pay off debts to increase your cash flow using a tool called a line of credit. And when we pay off debts, normally we're targeting the highest interest and lowest balance loans first. We take care of those loans, we increase our cash flow, and then the next step is once we've done all that, we take on the big kahuna, which is the mortgage. That's what I would consider the next step, paying off the mortgage. Now, the mortgage is a little bit different because it's your largest debt, right? So it's the highest balance of all your loans, and it's going to be the lowest interest. So there's going to be some nuances of how it's different from paying off your other debts like your student loans and your car loans. All right. So this is my case study. Here, we have a mortgage statement that I captured a screenshot online. So a couple things that I'll mention is that this maturity date here is that's the last date of the 30-year mortgage. So if you want to know when I got the loan, you just subtract 30 years. So I bought this house, I got a mortgage in November 2021, right? So November 2021, I got the mortgage. This is 1 year after November 2021. And to calculate how much I paid off, it's just the original loan amount minus the principal balance. So I've done that calculation for you. As you can see, I paid off about 25% of the mortgage in about a year, right? No, the average American does not do that. In fact, I'm going to go off on a little tangent here. The average American cannot pay off a 30-year mortgage in 30 years. What happens is that every 5 to 7 years, they usually either sell their home or they refinance, meaning in both situations that they get a new loan. So that's why they don't pay it off at 30 years. Another thing I want to mention is when I first learned about how mortgages work or velocity banking, I was so excited. I was like, man, I want to figure out what do people that I know, what do they owe on their homes? So I looked up addresses of childhood friends or their parents or people that I know. And this is really common in Southern California, where I'm from. Let's say people buy a home in the 90s for they bought it for $300,000, and then 30 years later they somehow own $300,000, or they bought a home in a nice area, maybe like $600,000, and then 30 years later they owe $1 million. You can find that out because that information is public data. So if you have access to the MLS, you can find that data. If you have access to a some sort of software service, you have access to the financial data of a home. Anyways, back to my point is that almost nobody does this. Almost nobody. Nobody pays off 1/4 of their mortgage in a year, except for me. I'm showing you that I can do it, and you can do it too if you have you know the right techniques and have the right tools. Okay. All right. So now here's the thing: if I want to pay off a debt early, I want well, if I'm going to use velocity banking, I want to accomplish three things. So first one is I want to pay off the debt quickly, right? Second one is I want to obviously pay less interest. And now there are situations where you pay off the debt quickly, but you still pay a ton of interest. That's possible. Another thing too is that you want to maintain control and liquidity of your money. So one of the common things that people talk about is, hey, well, I don't need a line of credit to pay off my mortgage quickly. Why don't I just directly overpay with savings? Well, if you directly overpay with savings, you lose control and liquidity. In fact, everybody has that option to overpay with savings, right? You don't need good credit to overpay with savings. You need good credit to get a line of credit, but you don't need good credit to overpay with savings. And the average American never does that because they know in the back of their mind, if they overpay that loan, let's say they put their entire savings in, they need an extra $10, they ain't going to get that, right? So this is what we're going to do with velocity banking. We covered it more deeper in Velocity Banking 101, but I just want to quickly review that. That's the whole point of velocity banking, and we're going to apply it to our mortgage. Now, some considerations with the mortgage, because the mortgage is a big debt and a low interest rate, it's actually not in your best interest to transfer the entire debt into a line of credit. And I'll kind of go over the numbers about that. So if you have a really big debt that's, let's say, like $200,000 and it's at a 5% interest rate, and you decide I'm going to transfer the entire $200,000 into that line of credit, and it's a much higher interest rate, you'll see that that's actually better just to do it in little chunks. And I'll show you what I mean by that. Okay. So the third point, we kind of already talked about it. So basically overpaying. Yeah. So when you overpay a loan, you definitely save money. I'm not going to say, oh, you don't save money. You definitely save money, but that liquidity is gone. And that's what you want. That's why most people don't pay off their loans, because they know overpaying means losing that liquidity, right? So I really want to emphasize that again. So I'm going to go over a lot of these nuances when it comes to paying off your mortgage. So here's my example. $210,000 mortgage at a 5.65% interest rate. And we're going to go over two scenarios. First one is paying off the entire loan with a line of credit that's at a much higher interest rate. And the second one is transferring that mortgage payment, overpaying it in small chunks to a higher interest line of credit. Okay. So let's just go over the first scenario. So I have this awesome velocity banking calculator here provided by Renatus. Shout out to Renatus. If you join our group, you'll be able to have access to this velocity banking calculator. This is part of our educational packages that we provide and distribute, and it's through Renatus. Renatus is awesome. So let me get back to my point. So now let's just kind of demonstrate some scenarios here. So this is a easy, quick cheat sheet of how much you would pay and how much you would save and how long it takes. So let's say I have a $210,000 mortgage, right? $210,000 mortgage at a 5.65% interest rate. So $210,000 mortgage. So, I put 5.56. And then this is a $1,200 payment if you do the math, or if you just do a quick Google search to figure out what the monthly payment would be. Now, let's say, so this is our line of credit information. Let's say, and I also want to show you our budget. As I said before, budget is important in a line of credit. So let's say I pay off this entire line of credit, or I'm sorry, this loan, and transfer it into the line of credit. And then take a look to the right. So you'll see that if we do that, even if the line of credit is at a higher interest rate, if we pay off the entire amount, it's going to take us about 7.3 years to pay off that line of credit, right? So, and take a look at the amount of interest that we're paying. So we're instead of 222,000, we're paying 139,000, and we save 82,000. So that's pretty good. That's pretty good. I'm not going to say that's bad. I mean, that's better than your average American who can't even pay off a 30-year loan in 30 years. So we paid it off in 7. But let's do a little bit better. So let's say that instead of paying the entire mortgage off with a higher interest line of credit, we just do it in $10,000 chunks. And then you'll see that we only paid $34,000. We paid off in 5 years, and look at the amount of interest saved. So it's almost like another $100,000 we saved in interest. So that's why, I'm not going to go too details into numbers, but with this Velocity Banking Calculator cheat sheet, you can see that you don't want to put the entire balance of especially a very big debt into a line of credit, especially if that line of credit is at a much higher interest rate and it doesn't free up too much cash flow compared to the loan amount. So just be aware of that nuance. Okay. All right. So now let me go back here. So we're going to go to our Velocity Banking average American example. So if we looked at Velocity Banking 101, I went over this example about paying off your student loan, car loan. Now let's just assume that this person now, with all the loans paid off, decided to buy a house, right? So instead of renting, we have a $210,000 balance at a 5.5%, 6% interest rate with a $1,200 payment. And so if you just kind of do the calculations, income's still the same. The expenses are now $2,200, and we have $0 in savings because when we use Velocity Banking, we're not using our actively having savings because we're going to pay off our line of credit in we're using our entire paycheck. So to figure out our cash flow, all it is paycheck minus expenses. So let's just do a quick Excel formula. So C2 minus C3, and we see that we have 2,800 in cash flow. Now, this is kind of similar to your average American scenario because we eliminate all our debt. But if we haven't eliminated all our debt, then our expenses would be much higher than they normally would. And you could see that in the Velocity Banking 101 video. Okay, so our cash flow is 2,800. And what we're going to do is we're going to transfer parts of our mortgage into the line of credit and then just do the same exact thing that we did in Velocity Banking 101. Now, before I do that, I do want to mention some things. So first of all, I have a couple of mortgage calculators here. So let's say with this person, we have our savings. We directly pay our savings into the mortgage. And let's see how much we save. 2,800 of dumping all our savings. So you can see that we save a lot. So instead of paying, so let me put this as 0 one more time, $222,000 in interest, if we add $2,800 of savings a month, we'd save a lot and we pay off that loan much quicker, right? So we pay it off in about 6 to 7 years because that's 24.9 years shaved off. So I'm not saying that you can't do that. Every person has the ability to do that, and you don't. And in order to get a line of credit, you actually need to have income and good credit. But in order to do this, you don't need credit. You just pay off your loan. But nobody does that because they know that the moment that I overpay a loan, I've lost that money. I've lost the liquidity. I can't do it, right? But you can certainly do it if that's your strategy. Okay. So let's not do that. Let's use the Velocity Banking way. So here's the thing, and here's another thing I want to mention. Even if, let's say using that line of credit cost me a little bit more than just overpaying the loan, maybe $1,000 or $2,000 or $3,000, I would still say it's worth it to maintain that peace of mind and to have that liquidity. So it satisfies the three options or the three things that I'm looking for. I want to pay off the debt quickly. I want to pay less interest, and I want to maintain control and liquidity. I need all those three things. So even if I pay a little bit more interest because I'm using a higher interest tool, like even like a credit card, which will be like 29, 30%, than just directly paying with my savings, I'm actually okay with that, right? Because I know that I'm in control of my money when I use it this way than using directly overpaying a loan with my savings. So I just want to throw that out there. Okay, so now what we do is we're going to transfer some of this mortgage debt into our line of credit. So what we should do is I'm going to transfer about 3 months worth of cash flow into the line of credit. So I'll just do 2,800 times 3. And I actually need to put it equals there. And how much is that? 8,400. All right, so that's 8,400 balance. And if you look at the Velocity Banking 101 video, you'll know how I did this. But basically, I subtract by my cash flow. So I just do H2 minus 2,800. Okay. Actually, this is not 3. Yeah, so this is 3 months worth of cash flow. And so every 3 months, let's calculate how much I would pay using the line of credit. So I'll just do, in order to calculate the interest, what you do is you take the previous month's balance, and this is the average daily balance, so this isn't going to be totally accurate, but basically take the previous month's average daily balance, multiply by the interest rate, and divide by 12. Always divide by 12, because when they quote an interest rate, it's annually, and when you're doing the interest calculation for the month, you have to divide by 12, and people get confused by that. So equals the previous month, H2, times 0.15, times 0.15 divided by 12. Okay, 105, 70, and let me go ahead and sum this interest up. So sum, yeah. So if I transfer some of the debt of the mortgage into the line of credit, so let's say I transfer about 3 months worth of cash flow payments, it's going to cost me $210. Okay, so now we can see if I use this Excel, well, semi-Excel, it's Google Sheets, mortgage calculator, I like to use this one when doing the chunking method or transferring little chunks to line of credit. It's a lot easier to see how much interest we save because it's, it shows the original amount, and it does a comparison compared to the other Excel spreadsheet, which does not do that. But so let's go ahead and use this one, and let me go transfer 84,000 or $8,400 of the mortgage payment into the line of credit. So we're just going to do that. So 8,400, whoopsie. So instead of paying just your normal amount, we're going to kind of overpay 8,400, right? And take a look at that. So if we just put in 8,400, we saved $28,000 of interest. And all we had to do was pay $210, right? And then we just rinse and repeat. So every 3 months, so 1, 2, 3, we just do it again. That's all we do. So I put in the first payment, I put in my paycheck, I take out my expenses, and then after 3 months, my cash flow will put the line of credit down to 0. So 1, 2, 3, and I put 8,400 again. And take a look at that. I saved $51,000 in interest payments. And all I had to do is just pay this amount times the number of times I chunk or use my line of credit. And we just keep going, right? So 1, 2, 3, 8,400. 1, 2, 3, 8,400. 1, 2, 3, 8,400. And then you just keep going. How easy is that? 1, 2, 3, 8,400. 1, 2, 3, 8,400. 1, 2, 3, 8,400. 3, 8,400. 1, 2, 3, 8,400. 3, 8,400. And you just keep going and over again. 2, 3, 8,400. 1, 2, 3, 8,400. 2, 3, 8,400. 1, 2, 3, 8,400. 1, 2, 3, 8,400. 1, 2, 3, 8,400. Kind of boring, right? 1, 2, 3, 8,400. And then you just rinse and repeat. 1, 2, 3, 8,400. 2, 3, 8,400. And then I think we'll get to an amount where if I overpay, it's actually more than the remaining balance. And I always get a little tripped up about how to overpay this because I was off by a couple of cents. Let's see if I just do 5,000. Will it work? Okay. So a little bit more I can do. So let's say I overpay 6,000. Okay. So as you can see, I paid off this loan using this method. I saved 292 months, and it would take 6 years, and we save $187,000 of interest, right? And so we only paid about 34,000, and you have to add the additional interest that you would pay to use the line of credit. But as you can see, we saved a ton of money. We saved a ton of money using this method, and it satisfies the 3 things I'm looking for when I'm trying to pay off debt quickly. So I'm going to pay less interest. It's really quick, much quicker than the average American. So this is, I think, about 6 years. So 2023, maybe a little bit less. So about a little bit less than 6 years. And I gain control and liquidity of my money, because here's the thing. As I'm using my credit line, right, I don't need to put the whole entire balance in the credit line. And as I showed you before, that it's actually not in your best interest to use the entire credit line. One is that you want the credit line to be able to pay off the principal balance of the loan quickly to kind of overpay. But at the same time, you want to be able to maintain your liquidity. So for example, if I put in the entire balance and something happens to me, I lose that liquidity because I'm at the top of the limit. But if I'm only transferring maybe a smaller amount, like 10,000 or 8,000, I got the rest of the balance just in case I need emergencies, right? Even here, if I'm here, then okay, if my cash flow isn't, let's say 2,800, and I need an extra 100, 200, even $1,000 expenses, I'm not sweating. I'm okay, because I got the line of credit to help me to maintain my liquidity and at the same time overpay the loan, right? So this is what I'm doing in a nutshell right here. So it's what I'm doing, and that's how I was able to get from 1 year from 238,000 to 179. And if you look at the average American, as I said before, after 1 year, like that number barely goes down because they're just mostly paying interest. Like it goes like 238,000 to maybe, I don't know, 236. But I'm at after 1 year, I was at 179. So you know that it worked for me. I don't know if it worked for you, but if you want to get mentored by us and join our group, go ahead and copy and paste that Google form link down below in the description, or email us, and you can find our email on the About page of the YouTube channel. So this is Korea Atlanta Mentorship. If you have any comments, questions, leave them below in the chat box, and we'll see you in the next video.